Well, good morning, everybody. And if it's still appropriate to say so, can I just wish you all a happy new year? Thank you for joining us for our first webinar of 2025, which is our technical roundup covering economic overview and accounting, tax and legal update. We've certainly got a jam-packed agenda. My name's Fiona Condon. I'm an audit partner and BDO's National Head of Charities. This morning, I'm delighted to be joined by a special guest, Andrew Studd, a partner and charity law expert from Russell Cook. At the end of the session today, Andrew will provide an overview of charity law developments. I'm also delighted that I've got a host of really brilliant BDO colleagues who've joined us this morning. Robin's going to be covering a technical update, and I'll update you briefly on where we are with the new SORP. Chris is covering VAT, Caroline, employment taxes, and Heather will be covering an update on direct tax. However, we'll be starting the session with an economic update, and I'll introduce our presenter shortly. We recognise that many charities are facing uncertainties looking ahead due to continued cost and income pressures and increasing demand for their vital services. We really hope that through our session today, we'll give you confidence to tackle some of the current and impending changes which are on the horizon. The session will be recorded and will be available for you to share and download after the event. So if you've missed anything or want to share the content with colleagues, there'll be a chance to listen back. We'll also ensure the slides are available to download. At the end of each of the sessions on accounting, tax and legal updates, there will be an opportunity for our speakers to answer just one or two questions. So please do use the Q&A function at the bottom of your screen. If we don't have time to answer them all today, we will respond to these after the event. And of course, you're welcome to follow up directly with any of the speakers if that would be helpful. We will conclude the session at 11:30, and assuming everyone runs to time, we'll endeavour to incorporate a very brief comfort break partway through the session this morning. So without further ado, I'm going to hand you over to our first speaker, Jyrki, who's going to give us an overview and an update on the economic environment.
Thank you, Fiona. Hi, everyone. Morning. My name is Jyrki. I lead the economic consulting team at BDO. And this morning, I will just start the session by setting the scene with a quick look at the sort of the economic climate and outlook, and then quickly also look at some data on charities and outlook for charity funding. So let's go to the next slide. And the one after this one. And one after. Thank you. So the headline on the UK economy from recently, so this looks sort of 2 years past, is that the UK growth as measured by GDP continues to be quite slow post-COVID. The latest estimate actually for the Q3 24 showing zero growth. You should take all of these quarterly estimates with a pinch of salt. ONS revises these figures regularly as we go forward, and to some extent, quarterly movements don't really mean much. But the key point of the recent history, as you probably have experienced, is that the growth in the UK continues to be quite slow and then sort of up and down around zero. On the next slide, then, the relatively good news on the economy is that inflation seems to be back under control and sort of looking to stay there. However, that has come at the cost of high interest rates, and those rates are possibly staying higher over the medium term. And those interest rates being high, obviously, some attribute that to being a brake on growth. Also, good news, slight news on this slide from workers' point of view, is that wage growth continues to outstrip the current inflation. Obviously, there's still ways to go before sort of real wages recover to go to the pre-cost of living crisis level, and that's as expected. Usually, that wage growth always lags behind inflation a bit, but the positive spin on this would be that it continues to move in the right direction. Further on workers on the next slide, I just wanted to also put up some data on sort of unemployment and vacancies. So looking at this, unemployment rate has gradually risen, but really kind of remained quite stable since 22. However, vacancies continue to fall. And some businesses, likely charities in particular, would be affected by the budget measures from the autumn to increase in national insurance contributions, the threshold change and the minimum wage changes. Now, that is probably not showing in this data yet. So the latest data point here is in July, September 24. So the question here is whether that, on vacancies in particular, whether that continues the trend downward or whether it will accelerate that trend in terms of falling vacancies. Moving on to sort of the outlook, looking ahead on the next slide, please. And one more. Thank you. These are the latest available GDP forecasts from the Bank of England. Now, Bank of England is due to update these relatively soon. So as with all forecasts, they are out of date almost as soon as they come out, but still informative. So at the bottom of the slide on the table there, you can see that the Bank of England revised its forecasts after the budget. So these forecasts are after the autumn budget, in terms of a higher growth expected in 2025 than previously, but that sort of comes with the price to be paid with a lower growth, slightly lower growth than expected in 26. And that's sort of typical. These macro models that produce these type of forecasts sort of are typically tend towards long-term trends and equilibria on long-term growth. So unless there's something fundamental that changes in sort of economic the productivity, underlying the economy and long-term growth potential, you tend to sort of budgets and monetary policy responses tend to produce these sort of shorter-term responses. So the Bank of England with this forecast is really saying nothing so far that they've seen from the new government is delivering that long-term growth switch. As always, there's lots of wiggle room in these forecasts. So looking at the chart, that darkest blue area in the chart is the sort of the Bank of England's central expectation range, and that varies roughly between 0 and 2%. So the Bank of England is really saying here is that growth could be anywhere. These things are uncertain. Growth could be anywhere between 0 to 2% over that period to 2027. And because they're sort of their central or their most likely estimate is that 1.7, slightly above the midpoint in that range, they're indicating that the risks on that are towards the downside. Turning to kind of outlook on inflation. Thank you. The bank projected a soft landing to about the 2% target by 2026. And again, this is a change since the budget. So on that basis, you could expect that interest rates stay quite stable or gradually steps down if the Bank of England just continues to target the 2% inflation level. However, you might have seen recent economic news and newspaper articles that indicate that the bank is already coming under some lobbying pressure to cut rates faster to boost the economy. That may be tempered by the falling value of the pound very recently, but nevertheless, there's some big policy decisions to be observed and made by the Bank of England over the next couple of monetary policy committee decisions on to what extent they will prioritize inflation or whether they will actually try to also stimulate the economy. Turning to specific to charities now. So I'm first going to look at a couple of these reports from 2024. Unfortunately, there's a bit of a data lag here that the latest data tends to relate to 23, but we've got In the subsequent slides, we've got a few more recent surveys that it's just interesting things to highlight, we thought. So according to the Giving 2024 report from CAF, charitable giving by UK households actually kept up with inflation in 2023. So that's good news. Obviously, underneath the headline, though, what's sort of driving that increase in donations from households or private individuals is the average size in donations rather than the number of donors. So there's a few donations, large donations that are helping or help donations to keep up with inflation, really, in between 22 to 23. Clearly, over looking back slightly a longer term, they may donations have not kept up with inflation if you look back since 2017. So on the right hand side there, we highlight the data on how the donation size is distributed, and the point there is that the median donation remained at £20, which is unchanged since 2017, and that would have had to be to keep up with inflation during that period through the peak of the cost of living crisis. That would need to be £25 per donation. So some challenges and catch up from there as well. On the next slide, unfortunately, the picture is a bit worse on donations on the business side. So the headline is that within the last year of data, from 22 to 23, donations by FTSE 100 companies fell by 8% in real terms in the year 23. So this is from their FTSE Giving 2024 report from CAF. Even more challenging, over 10 years, as shown on the graph on the left, while annual profits of the FTSE 100 increased by sort of 64 billion in cash terms, donations fell both in relative to the profit growth, but also in real terms, in cash terms and in real terms by 34%. So donations in 2014 used to be about 1.6% of pre-tax profits of FTSE 100 companies, and in the latest data from 23, they're just below 1%. The right-hand side of this graph, of this slide, puts these figures in some context. So the total donations from business. Now, if FTSE 100 businesses increased their donations in line with profit growth, that 2023 figure of 4.3 billion would have been 5.6 billion with no changes from donations in other businesses. So that fall in proportion of pre-tax profits going towards charitable donations is really impacting the numbers here. And then at the bottom, a more sort of an aspirational figure, I think, from the CAF, is that if all businesses gave 1% of their pre-tax profits, noting that about 75% of businesses outside of FTSE 100 do not donate, then the total corporate giving by businesses would be 9.9 billion. So more than double than what it is. So depending on your disposition, that's either an indictment of the state of affairs in terms of business donations, or it's an indication of potential upside if more businesses gave some more of their pre-tax profits to charity, or perhaps it's both. On the next slide then, it's perhaps not surprising then that charities state that they struggle to meet demand and that they feel the financial strain. So this is from a CAF survey that ran from May to June 2024 for about 800 charity leaders, where 86% reported increased demand, and 54 of the leaders surveyed said that their demand increased a lot. 70% of the leaders surveyed in this viewed the sector at best moderately healthy, or worse. And on the left-hand side of this slide, the chart shows the sort of the top 2 remedies, one or 2 key things that the sector would need to be more healthy, and the top 3 of those suggest a point to increase in funding. So 55% say improve funding directly, 32% talked about increased public funding, and 70% talked about increased awareness, awareness and reputation of charities, which obviously levers directly into funding. And on the right-hand side, there's some figures that are on demand, and then the pressures faced, less money to go around, and challenges from funding. In terms of 54%, that was up from 43% last year. Of those that said that survey, those surveys said that demand has increased a lot, and with figures there pointing to increased competition and funding and struggles with financial sustainability. That's leading impacts on workforce, with 30% reporting they're reducing workforce or plan to do so. So then that can only make the gap between demand and capacity to serve demand more challenging. Then finally, on the next slide, looking a bit more ahead, questions about funding can continue to loom large for the sector. As you probably know, if you're in the sector and live and breathe it every day. The budget would like to cover funding on the left-hand side of this chart, of this slide. That was some of the mixed bag. So clearly the national insurance changes, the minimum wage changes contribute to cost pressures. So they contribute this triple squeeze of increased cost, reduced funding, and increased demand. And those effects are probably felt more immediately by the sector, by the providers, than some of the funding initiatives that were also in the budget, as highlighted by the NCBO in terms of these initiatives, funding initiatives to trailblazer programs, mental health crisis centers, and so forth, that could alleviate some of the demand pressures for some charities over time. Finally, there may be some positive developments in the proportion of the public donating to charity on the right hand that we pulled out on the right hand side of the slide, with Enthuse reporting that the proportion of people who donate to charity has increased recently. So that might be a sign that the public are responding to the news and their growing knowledge of the pressures that the charities are under. And I was going to conclude there.
Thank you. Thank you, Erkki. That's brilliant. And just to reiterate, I know there's a lot of information in those slides, and they will be shared with everybody afterwards, so you can delve into some of those areas in a bit more detail. But thank you. So in this section, Robin and I are going to cover accounting changes that you can expect to see in 2025 and beyond. So on the next slide, I just want to start with some good news. Sorry, just move on again, Aaron, please. So the good news is that for charities reporting throughout 2025, there are no changes to the existing SORP, with the last one having been published in 2019. And you can see that on the next slide. So what we're saying here is that the requirements of the 2019 SORP will continue to apply for this year's financial reporting. Furthermore, there have been no new information sheets published this year to either enhance or clarify anything in the existing SORP. So we're eagerly awaiting the publication of the next SORP exposure draft, and charities should be aware of and take time to understand in detail the changes which already have been published through FRS 102, and that's something that Robin's going to take us through very shortly. Development of the new SORP has been delayed in 2024, but I'm pleased to confirm that we can now expect to see the exposure draft before the end of March this year. So on the next slide, I explain the timeline that we've got to in terms of this point and what we can expect the timetable to now look like in terms of the SORP. There is a mandatory requirement for a minimum of 12 weeks for consultation from the public from when the consultation goes live, so that date at the end of March. The SORP making body will then take a couple of months in the summer to review and update the draft SORP if it's necessary to do so, but it has to then go back to the Financial Reporting Council, the FRC, for approval before it can be published. The effective date for the new SORP will be the same as FRS 102, i.e. for periods beginning on or after 1 January 2026. And therefore, with the autumn date for the SORP to be actually released in its final form, you can already see that the timescales are quite short. So by way of a reminder, FRS 102 is the accounting framework that all charities have to follow. The SORP only provides interpretation and application guidance where, for example, FRS 102 doesn't have those specific charity examples, or the requirements that are specific to charities don't otherwise exist. Please remember that the SORP cannot and therefore will not remove any of the specific requirements set out in FRS 102, and they're the things that Robin's going to cover shortly. So on the next slide, you can see here that we're anticipating that for the trustee report requirements, sorry, next slide, please, Aaron. The SORP will introduce the concept of further tiering in the reporting. This is what we're expecting. And this is primarily designed to reduce the perceived burden of reporting for smaller entities. On the right-hand side here, there are a small number of other updates that we expect to see, and we still anticipate that full comparative disclosures are going to be required, and that's something which can often increase the size of a standard set of charity accounts quite considerably. Since its original application back in 2015, FRS 102 has been subject to a number of triennial reviews, but the last update, published in 2024, arguably represents the most significant suite of changes since its launch, and these will be reflected in the SORP. As a result, we do expect that many charities will face challenges, but there is a lot that you can already start doing now in order to plan and get ahead. And this might include engaging with your auditors or other professional advisors to obtain a thorough understanding of the changes which are coming. And of course, at BDO, we expect to be running more webinars and tailored sessions to support the sector over the coming months too. So if you just flick forward, please, to the next slide, I'm going to hand over now to Robin to take you through some aspects of the important changes that we can expect.
Thanks, Fiona. If we could just flick on one slide, please. So as Fiona referred to, FRS 102 has been through its latest periodic review by the FRC. So following a consultation period, the final amended version of FRS 102 was issued back in March. So if we just move on to the overview. So the changes include the introduction of a 5-step model based on IFRS 15 for income recognition. This may impact the timing of income recognition for charities with contracts for services and other contract income. The changes will also bring on-balance sheet lease accounting modelled on IFRS 16, which will impact charities that hold operating leases as the lessee. The amendments to the standards also introduced various other incremental improvements and clarifications, but we will not cover the detail of these in the time that we have today. As Fiona referred to, the effective date for the amendments are accounting periods beginning on or after 1st of January 26. So if we just move on to the changes in revenue accounting, just one more, please. So section 23 of FRS 102 introduces a single comprehensive 5-step model for revenue recognition. And this is for all contracts with customers, based on identifying the distinct goods or services that have been promised to the customer and the amount of consideration to which the charity, in this case, will be entitled in exchange. Non-exchange income, so including grants and donations, are specifically excluded from the scope of section 23 on revenue contracts. So we will continue to look to the SORP for the accounting requirements in respect of non-exchange income. The core principle is in section 23 of the amended standard is that revenue should be recognised to depict the transfer of promised goods or services to customers. So these are the performance obligations under the contracts. In contrast, the existing version of FRS 102 bases revenue recognition on the transfer of risks and rewards. So the 5 steps that will be applicable are listed on the bottom of the slide. So step 1 is you identify the contract for accounting purposes. Step 2 is to identify the promises included in the contracts. This is the transfer of goods or services that are distinct from one another. These need to be separable, and the customer needs to be able to benefit from each in isolation. Under step 3, you identify and you determine your overall transaction price under the contract. Step 4, you allocate that transaction price to each performance obligation, which you've identified in step 2. This element may require some estimation. And then finally, step 5, you recognize your income once you've satisfied each of the performance obligations. Now, if we just move on, I just want to run through sort of an example to illustrate this. So if we think about a charity managing a heritage asset for which it generates income as a visitor attraction. So an individual enters into a contract with the charity and pays £100 for annual pass. This provides unlimited visits, free car parking, and entrance to a winter event in December. The charity assumes visitors purchasing the annual pass will visit 4 times per year on average. Visitors not purchasing an annual pass may separately purchase tickets on a pay-as-you-go basis, so £20 for entry, £10 for car parking, £30 for a winter event. If we think about the existing FRS 102, so the charity has a policy that says they'll recognise the £100 annual pass on a straight line basis over the 12-month period of the pass. And if we think about the amended standard, the charity will identify the performance obligations that are separable and where the customer can benefit in isolation. So we think about the entry, the car park, and the winter event. The transaction price from the individual purchases is set out on the step 3 column there on the slide. But where you put where the customer purchases an annual pass, that's capped at £100. So one of the questions we'll need to think about here is how might that transaction price be allocated to each of the performance obligations identified in step 2. So for simplicity, we've assumed that the entry and car park elements are spread evenly over the year. But if you're in a situation where it's cyclical, you've got a pattern, let's say a concentration in the summer months, that would be considered when we're thinking about the timing of the recognition of income. So straight line for that element over the course of the year may not be appropriate. So if we just move on one, so in this case, the entity may use the single visit purchase price as a proxy for allocating the £100 to each of the performance obligations. So the £30 purchase for the winter event is 20% of the total fee if the individual paid for each single visit. Therefore, the entity can allocate 20% of the £100 to the winter event and the remainder to the entry and car parking. Now, this is intended to be a fairly simple example for illustrative purposes. But even here, you can see there are assumptions and complexity associated with determining when income is recognised. So if the assumption were that annual pass members attended 3 times a year or 5 times a year, then the amount of revenue that you'd be allocating to the winter event would then increase or decrease. So if we move on to consideration of leases, and just one more, please. So under the amendments to FRS 102, on balance sheet lease accounting will now be applicable. This includes some optional simplifications from IFRS 16. This will bring significant changes in accounting and reporting requirements for lessees, but minimal changes for lessors. So before we consider the requirements, I just want to pick up next the couple of exemptions. So we just flick on to the next slide, please. For lessees, Section 20 of FRS 102, like IFRS 16, contains 2 optional exemptions from the general requirement to recognise a right of use asset and lease liability on balance sheet. So these are short-term leases and leases for which the underlying asset is of low value. So short-term leases, first of all, they're defined as leases that at the commencement date have a lease term of 12 months or less. A lease that contains a purchase option is not a short-term lease by definition, and the options to extend or terminate the lease are considered as part of the 12-month test where it's reasonably certain that they will be exercised. The short-term lease exemption is applied consistently across underlying assets, all underlying assets that are in the same class. For the low value exemption, whether an asset is low value is determined based on the nature of the underlying asset. So items like vehicles or land and buildings are specifically not considered low value under FRS 102. So whether a lease is low value is not judged by reference to materiality. So a leased asset so if a leased asset is considered to be low value, that would be low value whether you are the smallest of charities or the largest of charities. Other thing to note is that the exemption is applied to each individual asset. So if you are a charity that has, let's say, 100 individual low value leases, you're not required to consider the aggregate effect of those 100 leases. You can consider the exemption on a lease by lease basis. If we just move on to the transition requirements at the point of implementation. So at the point that the amended standard is effective, there is an option to restate comparative information for the revenue changes for the lease amendments. So instead, a modified retrospective approach is adopted for leases, and that may be adopted for the revenue changes. So in practice, what this means is that the opening balance of funds will be amended at the date of transition for the effect of any change. So if you're a December year end, you will amend and you will recognise an amendment to your funds as at 1st of January 26. You will not go back and restate 2025. If we just move on to the next slide. So leases, this is in respect of lessees. So lessees are now required to recognise a lease liability on their balance sheet that reflects the promise to make future rental payments under the lease contract. So at the same time, you have a corresponding right of use asset also recognised on your balance sheet. So in terms of initial measurement, at the commencement date, a lessee shall recognise the lease liability at the present value of the lease payments that are not paid at that date. These lease payments are discounted using an appropriate rate, and I'll come on to that next. There are various other elements on the slide there that feed into the calculation of the lease liability, such as the exercise price of a purchase option. Again, if the lessee is reasonably certain to exercise that option. In terms of the right of use asset, the starting point for the cost of the right of use asset is the amount of the initial measurement of the lease liability. When a lease contains a non-exchange element, so because the lease payments are significantly below market rents, the corresponding income is accounted for as a contribution to the right of use asset. There are various other adjustments there that also flow into the cost, and that includes the effect of lease payments made before or after the commencement date, any initial direct costs incurred by the lessee, effectively the provision for any dilapidations associated with the asset, and then we take off any lease incentives received. So the next slide covers discount rates. As I say, the lease payments included in the liability are discounted. First, the starting point for this is the interest rate implicit in the lease, if that rate can readily be determined. If that cannot be readily determined, the lessee chooses on a lease-by-lease basis to either apply the incremental borrowing rate or the lessee's obtainable borrowing rate. In the absence of an existing borrowing rate, the standard enables public benefit entities, so including charities, to use the rate of interest that would otherwise be obtained on deposits held with financial institutions. However, this is considered to be a final option. So a charity would first need to determine whether it could identify the rate implicit in the lease, either of the obtainable borrowing rates, before then going down to the deposits held with financial institutions. One other point to note on discount rates is a single discount rate can be applied to a portfolio of leases, provided they have similar characteristics. So this is considering similar terms, similar type of assets. So as an example, this might be a useful expedient for charities with a large retail leased estate, for example. So next slide covers subsequent measurement of the right of use asset and lease liability. So after the commencement date, a lessee will measure the right of use asset either by applying the cost model or the fair value model. The fair value model will apply if the asset meets the definition of investment property, or the revaluation model is adopted for property, plant and equipment. So under the cost model, the right of use asset is measured at the original cost, less accumulated depreciation and impairment, and then adjustments for any lease modifications. On the liability side, we take the initial liability, we increase to reflect the unwinding of the discount. We reduce the liability to reflect the value of lease payments made in the period, and then we remeasure to reflect any reassessment or lease modifications. The next slide, this summarizes, I suppose, how the leases will be presented in the financial statements, what will be the areas that will be affected. So as I've noted, on the balance sheet, we'll have a right of use asset and a corresponding lease liability. In the SOFA, we will recognise an interest expense on the lease liability, and we'll also have depreciation charges on the right of use asset. So importantly, this may well differ to your current SOFA charge, which at the moment for an operating lease will be equal to the operating lease payments that are due for the period. In the statement of cash flows, the principal element of lease payments will be included in financing activities, and the interest element will either also be in financing activities or operating activities, depending on your accounting policy. So lease payments for lessees that are not recognised on balance sheet. So if you've got a lease that's not recognised on balance sheet, whether that's, let's say you've taken a short-term or low-value exemption, they will continue to be presented within operating activities. So my last slide on FRS 102. So this kind of comes back to the sort-making body update that Fiona referred to. So that when they've released details of the timetable that we can expect, they also refer to a series of actions that charities should be taking to prepare for the changes that are coming. So really, what should charities be thinking about now? In terms of leases, I think review your current lease arrangements. Consider, have you got a complete population? Have you got copies of the agreements? Establish whether current leases would qualify for any simplification, i.e. short-term or low-value leases, and therefore identify what leases will need to be accounted for on balance sheet. On the income side, review your current contracts and income streams. Charities with contract income will need to go through that 5-step process and assess whether there are any revenue recognition changes. So having a complete contract list, documentation of the key terms of those contracts, and what promises have been made under each of those contracts is a key starting point here. Also consider what record keeping would be helpful to implement now to assist with future preparation of the financial statements. In terms of other considerations, there are potential ramifications also arising as a consequence of these changes. So where we're bringing the leases on balance sheet, the change in the asset position, for example, may impact covenant calculations if you're a charity with current borrowing or planned future financing arrangements. In addition, any potential change in the balance sheet asset values may cause some charities to cross the audit threshold. So currently, an independent examination is permitted if you have gross income of, so where you have gross income of more than 250,000, you can have an independent examination provided your gross assets are not more than 3.26 million. So where charities that are in that sort of ballpark in terms of size, they're bringing significant additional assets onto the balance sheet, there is a risk that some may cross into the audit threshold. I think as Fiona noted, charities should also seek professional advice and consider speaking with their auditors or independent examiners. We also recommend referring to FRS 102 and the resources released by the FRC. These include some detailed fact sheets and worked examples for the lease and revenue changes, which are also helpful starting points. Okay, so I now just wanted to pick up a few other reporting updates and reminders. So we just flick on, I think, another one, please. Thank you. Right, so changes in company size thresholds. So the government has published new legislation, so the company's regulations 24, which will increase the monetary size thresholds for micro, small and medium-sized entities. Broadly, the turnover and balance sheet thresholds have been increased by around 50% from the existing levels. As a reminder, charitable companies must meet 2 or more of the thresholds to fall into the relevant size category. These changes are effective for periods commencing 6th of April 25. So if you're a December or March year-end charity, a charitable company, I should say, this will be effective in the same period as the FRS 102 or SORP changes. If you're a charitable company here that moves from a large to a medium-sized category, there will be certain exemptions from the strategic report perspective that you'll be able to take advantage of, for example, the section 172 statement. And on the next slide, so there are a number of, so for large and medium-sized companies, the legislation will removes a series of the director's report disclosure requirements. So there are 7 areas there listed on the slide. The intention is that this will lead to some simplification in annual reports. It will remove certain requirements, for example, there around engagement with employees, customers, suppliers, and financial instruments from the front end. But I suppose the important thing also here is that this is for periods commencing 6th of April 25. So the existing requirements remain in place for current reporting periods. So on to the next slide. Also just want to highlight a few other reporting developments. So the Charity Governance Code, a public consultation on the Charity Governance Code was completed last year to review the code's content structure, make sure it remains relevant to users. The code sets principles and recommended practice for good governance. It isn't mandatory, and an updated version is still yet to be released. So we'll watch this space for that one. The FRC has proposed revisions to its 2016 guidance on going concern. So the proposed guidance includes enhanced disclosures, enhanced disclosure recommendations where significant judgment is involved. So this is where there's significant judgment around the going concern conclusion itself. So is the going concern basis appropriate, but also where there's significant judgment in determining whether material uncertainties exist or not. The FRC has also published its 2024 review of corporate reporting and its expectations for the 2025 reporting season. They emphasise the need to step back and consider whether the annual report and accounts, when you take as a whole, tells a consistent and coherent story, and also to focus on providing material disclosures that are clear, concise, and specific to the entity. They also highlight that good quality reporting doesn't necessarily mean more in terms of volume. And finally, the FRC has also published its review of reporting by the largest private companies. Some of the key points in note in there are around enhanced descriptions of the nature of the entity's operations to help the readers' understanding, and also the benefit from of greater clarity around sensitivities in estimates and judgments. So quantifying those assumptions and sensitivities. And I think all these points are equally applicable to charity preparers, irrespective of whether you're a charitable company or non-company. So my final slide, I think this just brings this session to an end. If we can just flick on one, please. Thank you. I just wanted to kind of wrap that all up with a couple of key messages. So the FRS 102 amendments will bring significant changes for charities that have exchange income from contracts or that are lessees. So there are some practical expedients and exemptions included in the standard. But I think irrespective of that, this is likely to present some significant reporting challenges. So we do encourage charities to consider and prepare early for this. So ensuring your accounting records are enhanced for the new requirements, but also particularly considering if you do or don't have experience of IFRS 15 and 16. Fiona also took us through an update on the charity SORP with draft amendments due to be released by March. There will be a short period between the final amendments being released in the autumn and the effective date of January 26. So the other point here is that we've also released a guide setting out the significant differences between the old and amended FRS 102, tailored to charities, and that is available on our website as well. I think that's from me, Fiona.
Great, thanks. If I could just ask you to stay on, Robin, we have got a few moments to run through some of the questions which have been coming through, and obviously this is an area where, as we would have expected, there's a lot of interest. So somebody's asked a question here about office lease rentals, and I suppose particularly where we've got properties that might be rented between different entities within a group. Are they going to be captured by these new lease requirements?
Yeah, so in principle, if they meet the definition of a lease, then yes. I think the things I referred to, the FRC's fact sheets. There's one particular one. There are several documents they've released, but one particular one on leases is probably helpful here, and it does refer there to. So yes, it would be captured and come on balance sheet, but that's assuming it meets the definition of a lease. So does the entity have the same rights to that asset that it would if this were, if it had been leased to an external party? So you need to consider the actual arrangements that are in place between, let's say, a parent and a subsidiary. Does that meet the definition of a lease in the first place? And has it been identified as a lease up to this point, before then considering, okay, what's the accounting implications of that?
Yeah, thank you. And what about software as a service? Do we think those arrangements, or the type of those arrangements, will get caught by this? Does it just depend again on the nature?
I think there's a nature consideration. I think with regards to, I suppose, which assets do and don't come into the scope. I say FRS 102 is quite clear in the sense of it provides a list of leases that won't types of asset that won't be exempt, and referred to land, buildings, vehicles, that kind of stuff. there is, I suppose at the moment, some ambiguity around what assets will meet the exemption criteria. I mean, just as an indication, the guidance that sort of underpins IFRS 16 refers to sort of from a low value perspective to $5,000 US, and the FRC have said they expect that level to be higher, but they've not at the moment. I suppose the dust hasn't settled in terms of where exactly that will fall for FRS 1 and 2 preparers. So again, I suppose I'd refer to the guidance that is there from the FRC perspective. I think thinking will evolve, and as practice, as people kind of go through their first year reporting on this.
Yeah, and as I say, I would just reiterate the recommendation that when the exposure draft comes out, that you do spend time reading it through and thinking about what your comments or suggestions would be, because this is a great opportunity to provide clarification where it perhaps doesn't exist at the moment. But we'll watch this space. Thank you so much, Robin. I'm delighted to say that we are at the moment running to time. So as suggested at the beginning, we will allow you a very brief comfort break at this point. So do feel free to just pause, go make yourself a cup of tea, take a break, take in what we've just said. We'll have another opportunity to come back and answer questions on this session and any other sessions to come right at the very end. But we will start again very promptly at 10:30. So if I could ask you to come back online at 10:30, and we'll continue with our tax updates. Thank you. Okay, welcome back. And as promised, we're starting again. Now we're going to move forward to give you some updates in the areas of tax. So I'm going to hand over to my colleague, Caroline Jones from our employment tax team. Caroline, over to you.
Thank you, Fiona. So morning, everybody. As Fiona says, I'm an employment tax director, and I do focus on not-for-profit organisations. So if we just move on to the agenda this morning, I've been asked to speak on sort of hot topics, and I have to be honest, there's a lot going on in the employment tax arena and national insurance at the moment. So I've picked 3 that I think are the ones that we get asked the most questions about, or the ones that we're most seeing. So I'm going to kick off with mandatory payrolling of benefits. So if we could just move on 2 slides, please. Okay, so payrolling benefits, as it says on the slide, was originally introduced on a voluntary basis from 2017. So we do have quite a lot of clients who already put benefits in kind through payroll. But HMRC announced quite recently that they're going to make this mandatory from April 2026. So you might think, well, why are we talking to you about it this morning when we've got probably about 15 months before it becomes mandatory? And the reason for that is that at the moment, if you wanted to payroll benefits in kind, you need to get HMRC's permission, you need to register with them, and you need to communicate the change to your employees. Some of our clients are deciding that they might go early, that they might start payrolling benefits from April 2025. And that just means that they're able to test their payroll systems and they're able to test how it works for them before it actually becomes mandatory. So that's the reason why I'm talking to you about it this morning. It may be something you've just about got enough time to think about, perhaps implementing this from April this year. So one of the things that you do need to think about is allowing enough time, because it will require some changes to payroll. But the biggest thing I think that I'm seeing at the moment is about the processes, how you're going to capture the benefit information on a real-time basis. And this is why some of our clients are actually going early, so that they can make sure that they've got those processes in place. You need to get the data in real time for payroll, and they'll manage it and own the process. But it could be that you've got multiple systems, locations, and bringing that data together is going to be quite difficult for you. The point is that any benefits in kind that are payrolled, you'll need to make the calculations before the start of the year. So you can see for something like if you've got private medical, that might be quite easy because you know what the premiums are going to look like over the course of the year. But it can be a little bit more difficult with other benefits. And I'm going to talk about cars in a minute. But you need to do that year-end reconciliation. So if you're paid monthly, each month you will be payrolling 1/12 of the benefit in kind, but you need to make sure that by the end you have actually got that right. HMRC have been a little difficult in the past with employers wanting to register, and some employers have adopted effectively an informal system where they think, well, actually the tax and national insurance is going to be the same, so why don't we just do it? And HMRC have been pushing back on that quite strenuously lately. So if it is something that you want to think about, then really you should be thinking about that now. So if we go on to the next slide, please. So what does it mean for your organisation, whether you go early or you wait until April 2026? There are some complications here. So it could be that employees could make payments towards the cost of benefit. And if the full cost of that benefit is made good, then there's no taxable benefit for you to declare. So there's nothing to go through payroll because the whole cost of it's made good. But if, for example, individuals don't make good the benefit in kind until after the 6th of July, so the date on which Forms P11D would normally be submitted, then that making good is not taken into account. It doesn't affect the cash equivalent. So it means that the benefit will still be taxable and liable for national insurance. So it's really important that if you're in a position where somebody is making good a cost, that it is done before the 6th of July. But there's an added complication here. So if we're talking about company cars, and we do see organisations dealing with company cars through payroll, then if there's private fuel benefits, that needs to be made good by the 1st of June. So there's a bit less time actually for you to do that. So the other things that we see in terms of complications are about communication with employees. So again, whether you're going to go early or you're going to wait until April 2026, letting your employees know is really, really important. And I've had experience of this quite recently with a client where they just didn't communicate very well with their employees, and all of a sudden there were lots of calls because employees couldn't see what was happening and why suddenly a car was appearing on their payslip. So communication is really important. The other thing is there is actually a glitch in HMRC system. So if you have employees who are repaying student loans and they are under the self-assessment regime, at the moment, if they complete their self-assessment and they include the full earnings for the year, including payrolling benefits, it will throw up an underpayment of the student loan because student loan works off earnings, and the revenue have not yet recognised that those, and its earnings liable to Class 1 national insurance, so not the national insurance Class 1A that applies to benefits. So HMRC, when you complete your self-assessment return, would automatically apply student loan to the whole of the earnings, including the benefits in kind. And that means that employees are getting lots of notices of underpayment. Good time to be talking about it because we've got 31st of January fast approaching. So you may have employees asking you questions about that. Doesn't affect you as an employer, but it may be that you have a number of questions and people will want to know the answers to it. Okay, next slide, please. So having spoken about payrolling benefits, we're going to talk about the increases in national insurance, because this is a really big surprise, I think. I don't think many people thought that employers' national insurance was going to go up to 15% from April. So lots of organisations, and we've been thinking really hard about, is there a possibility that you can mitigate the costs? So it is quite a difficult area, but salary sacrifice is one of those areas that may allow for national insurance savings. So many of you may already have pension salary sacrifice in place. It's an area where employers and employees can make national insurance savings, and using that with using the pension contributions in conjunction with salary sacrifice will reduce your NIC bill. So it can be implemented for most pension schemes. There are some public sector schemes where they don't allow salary sacrifice, but it can be introduced for the majority. The important thing here is if you are introducing pension salary sacrifice, you make sure that employees know that any benefits or anything like that run off the pre-sacrifice salary. So good communication is really important for pension salary sacrifice. HMRC won't give clearance for salary sacrifice any longer. So if you've had arrangements in place for some time, you may remember that when you first implemented, you went to HMRC and asked them for clearance that your salary sacrifice arrangement worked from a tax perspective. They won't do that anymore. So it's really important that if you are going to implement something like this, you think about supporting paperwork, because that's really, really going to be the key if HMRC come in and have a look at it. And what about additional voluntary contributions? So many pension schemes will also allow for additional voluntary contributions via a salary sacrifice arrangement. So converting what employees pay into a salary sacrifice, making it an employer contribution instead. You could think about regular contributions, so it may be that somebody wants to make that additional contribution each month, or you can even think about lump sum additional voluntary contributions. But of course, there's always that national minimum wage hanging over you. So if you are going to do something like that, particularly around lump sums, then you do need to think about national minimum wage and making sure that you've got processes in place to ensure that you don't breach. Okay, so can we move on to the next slide, please? So pension salary sacrifice, I thought it was just worth having a little bit of an illustration about what it could mean for you. And don't forget that if you're sacrificing, if your employees are sacrificing salary, then you also save the apprenticeship levy if you're liable to pay that, because the apprenticeship levy runs off earnings subject to national insurance. And if you're doing a salary sacrifice, those earnings are no longer subject to national insurance. So just thought it was worth putting an illustration in here to show how you might save under the pension salary sacrifice. So if we go on to the next slide, please. So pension salary sacrifice is something that most people are familiar with. You might have the Cycle to Work scheme. So these are the sorts of schemes that HMRC are quite happy with. But the other thing that we're seeing more and more organisations looking at are electric vehicles. So salary sacrifice in exchange for being provided with a car. And more organisations are thinking about that. As I say, I know this is something that's a really hot topic in higher education at the moment because of the cost of those NIC increases. So if you decided that you wanted to introduce salary sacrifice for electric vehicles, couple of really important things to think about. First of all, let's not forget about national minimum wage. I mentioned that in terms of salary sacrifice for pensions, but that is your overriding. If there's any concern, that would be your overriding concern, to make sure that the systems identify that. The other thing is making sure that you get the right provider. So if you are thinking of introducing something like this, you don't want lots of extra work for your organisation. So getting the right car provider is essential, because what they can do is they can set up a system for you where your employees request to go into an electric vehicle salary sacrifice arrangement. Once you've signed that off to say that they earn enough, etc., then you would expect all the other paperwork and all the servicing and everything like that to be sorted out by the provider. So very important that you do that. The design of your scheme would be really important as well. So lots of people ask questions around early termination. So what if we've got electric vehicle fleet and somebody leaves? So it could be that if they decide to leave, so they're a bad leaver, as we call them, that they would have to pay. But also, if you've got somebody that you've made redundant, for example, then you could have early termination insurance built into your scheme by the provider, so that you make sure that you don't have any unexpected bills. The savings will depend on the model and the list price, obviously. The benefit in kind is going up to 3% of the list price from April. It has been 1% and 2% over the last couple of years, but there's some small increases coming in. But the really important thing to think about is the optional remuneration rules don't need to be considered for these sorts of vehicles. So for those of you who are unfamiliar with that, what it means is if you give somebody a benefit in kind that isn't accepted by HMRC or recognised as it by HMRC, then you have to look at how much is given up by the employee, compare it with the value of the benefit in kind, and whichever is the highest is the benefit you need to declare on a Form P11D. You don't need to do that with electric vehicles. So that's quite a big advantage. You would have to do it with other vehicles, but the rules don't need to be considered for this. So if we can move on to the next slide, please. So I just wanted to give you an illustration. I'm not going to go through this in its entirety, but it's worth having a bit of a takeaway. And this is about the employee, what happens to the employee. So in this particular example, we've just chosen an arbitrary £650 a month. So basically they give up £650 a month, but what it actually costs them, if you look down the slide, if they're a 20% taxpayer, then it's going to cost them £476. So it's a lot cheaper because of the salary sacrifice. So what we do is we look at the tax and national insurance that's been saved and take off the tax on the benefit in kind to come up with an annual cost and then split that into 12. So you can see this is quite a good way of employees having electric vehicles and perhaps making your fleet a bit greener. But let's have a look at the mitigation of costs for you as employers. So if we can go on to the next slide, please. So basically, using the same example, so say the salary sacrifice is £650 a month, you will now save from April NIC of £1,170. Offset against that will be any Class 1A NIC on the benefit, but you'll see from the previous slide that those benefits tend to be quite small, and 3% of the list price is going to be quite a small benefit. So actually what you will be getting is a net saving, and you will save your apprenticeship levy. So it's something to think about if you're thinking of introducing any sort of salary sacrifice arrangements. Don't forget to, in terms of your employees, this could have an impact on the higher child tax credit charge. So that is based on net earnings. And what you would see from this is that if you're reducing earnings, then it could have the knock-on effect of allowing them to keep some of their child benefit. So there's some things to think about there. Against that, we're going to go on to the next slide, please. And we're going to talk about HMRC activity, something I love as an ex-inspector, but we are seeing lots of HMRC inquiries. So we've talked about some opportunities, and now we're going to talk about what we're seeing from HMRC. So there's a lot of there's an increased number of reviews being taken, and they're training more officers. But what that means in terms of more officers being trained is that there are some delays in HMRC coming back to you. So they might get in touch with you to say that they're going to carry out a review. They might ask you for some information, but once you've provided that, you may find there's a bit of a delay in HMRC actually coming back to you. And I'm going to speak to you in a minute about what I'm seeing with some of my clients. But the change that we're seeing over the last few years is that many reviews now are focused on specific areas rather than looking at everything. So rather than looking at benefits in kind, expenses, operation of payroll, etc., they may think, for example, we think you might have a problem around expenses, and they will focus on that, or it could be relocation or something like that. So you could either have a wide review or you could have a much more focused one. And they're also asking for a lot of information in advance of the visit. So we'll look at what that might look like in a moment. You can go on to the next slide, please. So what are we seeing? This is typically what we will see with an HMRC review. So they always used to send letters, but now more and more we're seeing phone calls advising that HMRC would like to visit. And what I would say is make sure that you're really prepared for that visit. And if you know of any areas where you already may have risks, so say, for example, you're a bit concerned about something like relocation, or maybe there are some expenses, travelling subsistence is a big one at the moment, then it's really important that you try to get a handle on where your risk areas are. Because HMRC at that first meeting will ask you, is there anything you would like to tell us? And that's your opportunity to say. What's also a bit new in the last few years is you may well have somebody come to visit to review your systems in advance of any sort of main visit to talk to you about your procedures. So they have a good idea of how your systems work before they come in. Okay, next slide, please. So what should we prepare? What might we be asked for in advance? So you'll be asked for basic information, so employee numbers, checks and processes, how you do things. Do you have process maps? Do you engage off-payroll workers? Massive area of interest and focus at the moment. how your expenses and benefits work, so what your systems are, what the authorisation process is, etc. Travel costs, salary sacrifice arrangements, all these things will be something that you could be asked for in advance. Okay, next slide, please. And then I just wanted to cover off the main issues, main areas where issues are found. So as I said, off payroll workers, really big one at the moment, and HMRC have got a number of reviews going on, and I've had to make voluntary disclosures for at least half a dozen clients in the last 12 months. Got termination payments, unfortunately a fact of life at the moment. Your expenses and pays you in settlement agreements if you've got them, accommodation and salary sacrifice. So encouraging you to do salary sacrifice, but if you do, make sure that you get it right. Okay, so next slide, please. So actual experience of reviews. So just really quickly, as I said, we've got half a dozen voluntary disclosures at the moment that we've made to HMRC, and we've told them exactly what's gone wrong. Really important to say why it's gone wrong, what you've done to identify it, why it won't go wrong in future. So lots and lots of reviews out there, but if you get the opportunity to do that, it helps you take control of the review, and that can have a really, really good knock-on to the penalty regimes. So if we could just look at the next slide. So the penalty regime, I won't go through all of this, but the penalties depend very much on your behaviour as an employer. So it could be that you've made a mistake and there would be no penalty, or it could be it's deliberate and concealed. And you'll see there that I've got unprompted and prompted. The difference between those two are if you become aware before HMRC tell you they're going to review that you've got something wrong, then going to HMRC and telling them is the best thing you can do, because as you'll see, the unprompted disclosures are much, much lower, and very often you could get no penalty or even a suspended penalty. Next slide, please. I just thought it was worth putting this slide in. So this is my final slide, just to let you know about time limits. So again, I won't go through those, but you can see that they tie in very nicely with the types of behaviour in the previous slide. Okay, that's it. Thank you, Fiona.
Thanks, Caroline. Just time for one quick question, if I may. So there's a few that came through on the chat. So somebody's asked, am I correct in thinking that if I go down the salary sacrifice route for pensions, that the government tax relief is lost for the employees as the combined payment is made as an employer payment?
No, it isn't. So they get exactly the same tax relief, but they get it in a slightly different way. So they will get it through their pay slip rather than getting that credit. But the amount that goes into the pension scheme would be exactly the same, and the tax relief that they get will be exactly the same. And in fact, if they're 40% taxpayers, it accelerates the 40% because you only get 20% from HMRC, and if you're 40%, you'd have to claim it through tax return. So if you did salary sacrifice, you wouldn't have to do that. You get it at source.
Brilliant. Okay. Thank you so much, Caroline. That's great. If we've got time at the end, I know Caroline will stay around to answer any other questions just before we wrap up at the end, but thank you so much. So at this stage, I am going to hand over to Chris now, who's going to cover some VAT updates.
Thanks, Fiona. Cool. Next slide, please. So, yeah, so we're just going to whiz through new legislation in indirect tax, some litigation, and then some general HMRC updates, and then a sort of grab bag of other things to be aware of. Most of it's forward-looking, but the little bit is stuff that's just happened. So turning to legislation first, there are two big changes for the wider not-for-profit sector, I suppose. One of them has been very, very widely publicised, which is, of course, VAT on private education, which is now 20% falling outside of the exemption for education for private schools. And I'm sure you will all seen the headlines on this and the back and forth and the policy rationale and whatnot. In terms of the actual technical aspect, there's almost a two-stage removal from the exemption. So first off, you've got to decide whether you're a private school, and that can be quite tricky. It's obviously someone who charges fees to individuals, but also someone who's provided either a school that provides education for those of compulsory school age, 5 to 16, or an institution that provides education suitable for those 16 to 18-year-olds. which charges a fee as well. So there is quite a lot of complexity. Whilst you can say Eton is definitely a private school, can be quite a lot of complexity for foundation providers or people who deal with those ages sort of 17, 18, 19 pre-university, where actually it's not really clear whether you're a private school or not. And then once you are a private school, the education exemption is removed in respect of your education for basically people between the ages of 15 and 18. So the exemption still remains for those who are providing higher education. It remains for those providing nursery care, and remains for those providing charging for exams separately, and for English as a foreign language. So it sort of has as well as increasing the tax, it also means that the actual VAT compliance position for those sort of providers remains quite murky, and even when it is all cleared up, quite complex, because you are within partial exemption. Then the probably lesser known law change that will affect not quite a few, but certainly some charities, is a new statutory levy on gambling activities, which has been tabled, I think, yesterday or a couple of days ago. The idea is to replace the voluntary levy. Previously, the Gambling Commission asks anyone involved in gambling to pay 1% of their revenue to the Gambling Commission to let them spend it on treatment, research, and education. This has changed, will change from the 1st of April, or 6th of April, to make it a mandatory levy, where anyone involved in gambling, so that's anyone who holds a UK Gambling Commission license, will be required to pay a statutory levy by October 2025, ranging from 1.1 to 0.1% of their UK gambling revenue, effectively. This does include society lotteries, so charitable lotteries and the like are still included in this levy, and there will be a 0.1% rate applied to their effectively their earnings from the lottery. So if now is probably a time, if you do have a UK Gambling Commission license, to take a look at your last regulatory returns and see how much you have declared as income to the UK Gambling Commission, as that will be what's taxed under the levy. And it is confirmed it does apply to society lotteries, even though obviously it's sort of taking from charities to give to other charities. The consultation did consider that and thought it's still fair and reasonable to apply a levy at a lower rate. Next slide, please. So litigation, there are a couple of quite big cases. The first one is Hotel Latour, which is going to the Supreme Court sometime this year. The case involves VAT recovery on cost associated with selling a subsidiary. So whilst there are obviously some parallels for the charitable sector in that, especially if you're looking to sort of retrench and have a look at your balance sheet and what you want to do with it, possibly the bigger draw across is that most of the arguments so far are focused on financing costs, i.e. the sale of the subsidiary was financing. And most of the arguments have then talked about financing in a wider sense. So financing being getting loans, sale of subsidiaries, obtaining equity income. And there is an obvious parallel to charitable fundraising, where historically HMRC have generally accepted the costs of fundraising can fall to be residual, so partial recovery on those costs. That was thrown into doubt a bit by University of Cambridge decision a few years back, without HMRC having really officially made any policy on it or said they changed their policy. So there's been a bit of wariness in the sector since University of Cambridge. And so this is definitely one to keep an eye on, because what the Supreme Court might say could well have wider impacts on, as well as sort of sale of subsidiaries and sale of financing and raising of loan borrowings, also on the raising of charitable fundraising, and whether that VAT can still be partially recovered or if it actually should be blocked entirely. Very recent decision was Yorkshire Agricultural Society in the upper tier tribunal, so that means it is now binding. HMRC were challenging the application of the fundraising exemption because the Yorkshire show was doing more than just raising funds. It was also educating and, I guess, entertaining as well. HMRC tried to remove the exemption on the basis it wasn't primarily for the raising of money. And the upper tier tribunal disagreed, as did the first tier tribunal, saying that actually the UK legislation shouldn't be read as primarily for the raising of money, but promoted as being for the raising of money. So that position will now be binding, certainly in respect of the pre-2021 position. Obviously, it's a little bit more unclear since then how it works, given various EU withdrawal acts and the new incoming Labour government having reversed one of the EU withdrawal acts. And I know it's an area HMRC have been challenging, so this is actually quite a good decision for taxpayers in that position. And here's one to bear in mind when you are arranging events, which have fundraising and other aims. Especially, I mean, I guess the key overriding one is if you can make it very clear it's primarily the raising of money, that's the safest position to be in. But if there are multiple aims, then this court case does give you quite a lot of help. Next slide, please. So these are sort of a grab bag of HMRC publications and policy notes and things they have done over the last 6 months or so. So one of the big ones was Guidelines for Compliance 8. The Guidelines for Compliance series, which I think there are 11 of them now, are generally aimed at larger corporates. But in this case, HMRC were explicit that Guidelines for Compliance 8, which is help for VAT compliance controls, applies to all taxpayers, all VAT registered businesses. And it basically sets out the sort of controls, the sort of checks, and the sort of reviews that HMRC expect a reasonable taxpayer to take with their accounting processes and their compliance software. Obviously, it varies. They don't expect everyone to have the same level as a FTSE 100 business, but they do set out, which can be quite helpful, what they are looking for. So it's a good idea to, when having sort of a refresh of your controls and your especially documentation, to do that having a look at the Guidelines for Compliance 8. And if in the unfortunate situation HMRC are looking to levy a penalty for a mistake, it's also quite helpful to have a look at them to set out, well, actually, we have got these things in place. We have done everything that you've asked of us. It's just that sometimes mistakes do happen, as a way to show you've taken reasonable care and avoid those penalties that Caroline was talking about earlier. Guidelines for Compliance 11 is more niche, but it talks about the VAT position on fire remediation and cladding following the Grenfell fire. Broadly speaking, saying that HMRC's policy hasn't changed. Certainly the sector was hoping for maybe a bit more leeway in that, but it's no big changes, and it does leave certainly sort of housing association providers in possibly in a worse situation than commercial house builders, which is not a thing that I'm sure particularly the government has necessarily thought through. Then a couple of sort of almost tidy ups from leaving the EU and sort of changing the legislation to be UK focused is that non-UK charities have now been removed from HMRC's view of what a charity is, and so can't necessarily obtain the same access to VAT release that they would otherwise have done pre-Brexit. So one to be very aware of if you are an overseas charity. And finally, HMRC have been sending out a nudge campaign. So a lot of letters to generally medium, smaller sized not-for-profits, asking them, have they considered the non-business apportionment? So that is, have they considered putting in a VAT restriction for their non-business activities? Be that sort of things given away for free or grant funding being given away, stuff that doesn't really fall in the VAT net. Non-business apportionment is a lot more relaxed than partial exemption. Partial exemption has very strict rules. Non-business apportionment is done on a fair and reasonable basis. So it is one to take a look at if you haven't done recently, because it does change with the business, where the partial exemption, you just follow the rules and it comes to a mechanical outcome. Non-business can be a bit more subjective. Next slide, please. And finally, just a bunch of other things that we're keeping an eye out from a VAT point of view. From January, so start of this month, any B2C, so any sale to consumers in the EU of education, entertainment, musical, theatre productions, video, online education is likely to be taxable in the location of the customer. So that means EU VAT is likely to be due if you are selling services to EU consumers from the UK. So this is always, or not always, this is applied for the last 9 years for electronically supplied services. So if you download an ebook as a French individual from a UK company, you will UK company will have to charge French VAT, have to register with French VAT, but this has widened the net slightly. So it's pretty much all B2C supplies rather than just ones that are fundamentally electronic in their nature. So if you are making such sales, definitely very good idea to double check that and check whether those sales would fall within these new B2C rules. HMRC announced an e-invoicing consultation at the budget last autumn, which is due to be announced and published sometime this spring, I think. HMRC are somewhat behind the curve in terms of international comparators. They haven't announced any intention to mandate e-invoicing, and this is very much badged as an information gathering exercise about what do people feel, what's commonplace in the market, how often is e-invoicing used. So it should be an interesting view into HMRC's longer term plans, and also where the UK PLC is in terms of e-invoicing. Certainly the EU is planning to bring in mandatory e-invoicing by the end of the decade. It's very common in South America. I haven't heard a great deal of enthusiasm for it from taxpayers. Less mandation, please. But it could lead to HMRC setting out a sort of common framework for people who do want to use e-invoicing to stop the market fragmenting. And finally, one final litigation point on Hippodrome Casino, which is to do with partial exemption. So this is going to the Court of Appeal this year as well. So I probably won't hear it till next year, 2026, but it will give some interesting commentary on how cost components work within partial exemption, which is for many charities a very important aspect of that. And I think that is it for me.
Great, thank you so much, Chris. Just time for a couple of questions. From a VAT perspective, where are you seeing HMRC compliance activity the most in the sector?
So some recent stuff that we've seen that's not general HMRC activity is focusing on people who are not VAT registered and effectively asking the question, should you be VAT registered via the reverse charge? Generally, if you didn't have a VAT number, you could be pretty sure HMRC's VAT people wouldn't come and visit you. But I think there's been a bit of a compliance push to try and flush out ones where people have had reverse charge, that's buying in services from overseas, over the VAT registration threshold, £90,000, and creating a VAT registration obligation and then a VAT liability afterwards.
Yeah, so yeah, I've got direct experience of that as well. So I think the message there is, even if you're not VAT registered, do just take a few moments to think about the current environment and whether that still remains appropriate. And the second question is, someone's asked about schools that offer support for less able children, boarding and providing private schooling. Is there VAT on both the boarding and the schooling elements?
Yes, so the removal of the exemption applies to both the education and also the accommodation, if you like, the boarding. Yeah,
I suppose the upside could be a better VAT recovery position that may mitigate some of it.
Yeah, it will depend on how recently you've had any big capital expenditures as well. But there is a upside slightly, although it's unlikely to be better than the VAT you're paying out, sadly.
Great, thank you. Well, thanks so much, Chris. And we're going to move on now swiftly to Heather on corporate tax.
Morning, everyone. Can I have the next slide, please? I'd like to start with an update on the HMRC consultation on the charities tax compliance. Next slide, please. Okay, so this was launched by HMRC in order to tackle abuse of tax reliefs for charities, to make sure they still remain available for those that legitimately claim them. The consultation concluded last year, and HMRC published their outcome in October. It suggested 4 main areas as part of a charity compliance package in the autumn budget, which are set out on the slide. The first one, I'll just go through them briefly. The first one being the tightening the tainted donations test. And this is basically to prevent circular transactions where donors gain financial benefit from the donations that they make. For example, donating to charity, which then in turn issues a loan to the donor's business. So they're looking at exploring replacing it, the motive test that's currently in place, with an outcome test. And the second is the approved charitable investment rules. Again, HMRC want to limit abuses of these. And the example that they give is where a charity purchases a foreign property as a holiday home for trustees with no benefit to the charity, which currently is allowed as an allowable investment, as an investment in land, and it's automatically approved. They're looking at tightening this up. Thirdly, the non-charitable expenditure rules. Here they want to close the gap, because currently where non-charitable expenditure exceeds attributable income, there can be a lot of tax to HMRC. The way they're looking at doing this is looking into legacy income and the treatment of that for tax purposes. So just be aware of that. The fourth is the non-compliance with filing obligations, just to make it fair for the majority of charities that file on time, pay on time, for those that, and then there's those that don't. And so they're looking at kind of penalties or motivations to make sure that charities do all file on time and pay on time. They're looking at doing this through the fit and proper persons test. So those that are managing the charities. So just be aware of that to make sure that you know that you are filing on time, you know what your obligations are, because HMRC are considering a withdrawal of tax reliefs if not. The legislation are looking at have some technical consultation this year, with legislation later in the year, and then for implementation to take place in April of 2026. Next slide, please. Okay, this one is really for awareness and probably most applicable to the social housing sector. The Law Commission consultation is currently in place for cooperative and community benefit societies. The key thing to note on this is that there's discussions on whether charitable, cooperative and community benefit societies should cease to be exempt charities, which would require them to register with the Charity Commission to benefit from charitable status for tax purposes going forward. So watch this space if this applies to you. Just be aware of what's happening. I know that a lot of law firms are involved in consultation on this, which did stop at the end of last year, but we're waiting for the outcomes for that at the moment. Next slide, please. Okay, this is an issue that we thought had almost been resolved, but is still on the radar due to the change in the government. So the Digital Market Competition and Consumers Act 2024 states that gift aid can't be claimed, states that there's repayment condition into payments for membership subscriptions, which would otherwise fall within gift aid. And there's a condition for gift aid that it can't be claimed on a payment that's subject to repayment. So this is caught under this act, slightly unintentionally. And there had been consultation, and the previous government had agreed that there was going to be a statutory instrument passed before the relevant sections of this act come into force. We're expecting this statutory instrument in spring of this year, but it's been silent with the new government as to what's actually happening now. The impact being that charities now, it's unsure what the status is with regards to gift aid claims on membership subscriptions and meeting the requirements of this new act. So be aware of this, watch this space and see what happens. Next slide, please. Okay, the next two slides are just a summary of some of the things that are happening in taxes for charities at this time. One you may be aware of is that the rates for creative relief, for theatre tax relief, orchestra tax relief, and museums, galleries and exhibitions relief have now increased to be permanently set to 40% for non-touring exhibitions and productions and 45% for touring and all orchestra productions. This is great news for the sector in that they had previously been reduced and phased out. The second one, business rates, as I'm sure all private schools are aware, this has been removed. Charitable rates relief has been removed for private schools as of April 25. Thirdly, this is one just to be aware of. We had a recent conference with the Charity Tax Group, and HMRC emphasised that it is their duty to look into charities of all sizes. So be prepared. Don't think you're under the radar just because you're small. They have an obligation to take samples from everywhere. So make sure your house is in order. Fourthly, is the making tax digital with a view to the kind of future of gift aid project also. So HMRC at the same Charity Tax Group conference noted that there wasn't any key movements of this in the short term, but they are committed to working with charities on simplifying gift aid digitalisation, and emphasised that charities be involved, make your voice heard, get involved in these consultations, and it's likely to be small and incremental changes that are happening rather than something big, just due to constraints within HMRC. Okay, these are just 4 small areas just to be aware of. Gift aid, have oversight of your gift aid. There have been claims recently, cases recently, like Yorkshire Girl Guides case, where volunteers were fraudulently claiming some. Be aware of new systems. Also be aware of cost of membership benefits increasing against the cost of your membership. Be aware of transfers of monies overseas. HMRC are looking at these, and the other 2, again, are just standard. Just keep them on your radar and be aware of them to avoid any difficulties.
Super, thanks, Heather. I think we'll pause for questions. We'll defer the questions for Heather until right to the end of the session. And at this point, I'm going to hand straight over to Andrew.
Great, thank you very much. If I could have the next slide, please. Quite briefly, what we're going to cover, new and updated guidance from the Commission and their inquiry and compliance casework, a little touch on case law, which I'm afraid is mostly of interest to charity lawyers, and a brief touch on what's on the horizon. So if I could have the next slide, please. So most of the guidance in relation to the Charities Act 2022 has now been issued. The Act is fully in force apart from the ex gratia payment regime, which I'll come to a bit later. Protecting charities from abuse is reissued guidance in relation to trustees who have extremist views, for example. Accepting, refusing and returning donations is the main point I want to talk about. This has become very relevant with the sort of culture wars as far as controversial donors. So organisations linked to the Middle East conflict, organisations linked to climate change, and surprise, surprise, actually the Archbishop of Canterbury, who had one of his donations refused. The guidance touches on when you must return a donation, for example, where it comes from the proceeds of crime, where you might need to return the donation if it requires you, for example, to work outside your charitable objectives, or they've got really onerous conditions attached. The guidance mentions that you've got to have a power to return the donation. That's usually implicit, but it's worth checking your governing document to check that. And then really the main point is to say that despite what charity trustees' personal views are, you've really got to take an objective approach to what is in the best interests of your charity as to what impact accepting, refusing or returning the donation would have on your stakeholders and your donors. So it's really to make sure that personal views don't impact on your decision-making process. Campaigning political activity was reissued in time for the election, and the summary came out to say that the charity sector had behaved a bit better than it had previously. The last bullet point on this slide, guidance for local authorities. There has always been a bit of a problem with local authorities recognising when they held bits of land or recreation grounds or whatever on charitable purposes. They've had a tendency to sweep it all into an asset of the local authority. And this is a guidance note specifically for them from the Commission saying, no, you are trustees. And you'll see a bit later that they have begun to exercise their powers on that. I'll leave the last 3 ones to BDO because they're all about finance and internal financial controls, and they're much better able to discuss things like that than I am. It's worth everybody really revisiting the decision making for trustees. I keep talking to clients to say, the commission, if they ever come and talk to you, the first thing they will want to understand is what your meetings, what meetings were held and what decisions were reached at them. The importance of board minutes can't be emphasised enough. There are 7 principles in the decision making for trustees, and I think it's well worth everybody just revisiting them. And worth remembering that the Charity Commission does expect trustees and senior managers of charities to have read and understood guidance that is relevant to them. Lots of inquiries and compliance casework. Sorry, I hadn't realised these came on in little bullets. Please just flick them all through. I'm not going to focus on all of them, but the double defaulters inquiries that have been ongoing for a long time, which is for charities that have failed to file accounts or annual returns over 2 or more years, throws up lots of other inquiries. So you move from a double defaulter inquiry into a different statutory inquiry if the Charity Commission find issues. And I'm afraid to say they do tend to find issues. They do a lot of digging. If you get a visit from the Commission or you get an inquiry from the Commission, you can expect them to keep digging until they've found what they suspect. Just on the first double defaulters, the Calderdale Metropolitan Borough Council, they were issued for an official warning for failure to file accounts and returns for 13 charities that they are a charity trustee of. The Commission issued them with an action plan and they failed to follow that, so they got an official warning. It'll be interesting to see what else happens. The Kingdom Church was something you may have heard about during the COVID period, where one of the trustees claimed to have an oil that protected from the coronavirus. That trustee was subsequently convicted of fraud, but the Charity Commission then opened a case and they found that the charities hadn't had any meetings, there were unmanaged conflicts of interest everywhere. The charity didn't have its own bank account, but used private business accounts to funnel charitable funds through. They subsequently appointed an interim manager and the trustees were disqualified. Captain Tom Foundation, again, a high profile case, which really I think comes down to an unfortunate confusion of roles, a lack of clear agreements between what was Captain Tom and his legacy and what belonged to the charity. The public perception, I think, is that everything Captain Tom was for the charity, and I think it was duty bound on the trustees to make it clear how the split was. And I think there were some unfortunate unmanaged conflicts or perceptions that the family had benefited privately from charitable assets, which was not actually the case. Misapplication and breaches of trust. I mean, that's a core part of charitable law, which is trustees cannot benefit from their charity unless there are specific provisions in their constitutions that allow them to, for example, be paid. These also nearly always indicate that conflicts of interest haven't been managed as well. So Fashion for Relief was the charity set up by Naomi Campbell. The Commission picked up something in their annual return and approached the charity and gave them an action plan to sort some things out. The charity failed to respond to that action plan, evidently a big mistake. And they opened a statutory inquiry. They found that there were no minutes of meetings, there were low levels of charitable expenditure. Trustee expenses included spas, saunas, cigarettes. There was excessive expenditure on luxury flights and hotels and unauthorised charity benefits. So the Commission was unhappy with that. Burke's Peerage, similar situation where trustees acquired bits of furniture for using charitable funds and kept them in their own premises. So there was no public benefit, it was purely a private benefit to the individual trustees. Controversial views. Char Yar was involving a charity trustee who, not related to the charity itself, had been found to make speeches with extremist views, encouraging murder and all sorts of other things in the name of religion. That trustee was found to be unsuitable to be a charity trustee. Actors Benevolent Fund, just mentioned because that there have been increasing numbers of disputes, but within trustee boards as to who the members of the charity are, etc., etc. And the Charity Commission is the first place that most people go. And the Commission is very reluctant to get drawn into disputes. They did get drawn into this one, and they had to sort of apologise about the way they had approached it. The dispute was resolved, but after a lot of time and energy and money, and was certainly not in the best interest of the charity at the end of the day. These, I think, are all very helpful. They highlight issues faced by lots and lots of charities. Really, it comes down to understanding your governing document, really making sure you understand about trustee benefits, you understand about managing conflicts of interest. But once the Commission get involved with you, expect them to keep digging. So it's very important to be prepared. Ignorance of the law is no excuse. And some of these inquiries show definite culpability as far as criminal acts, others less so, others more confused, a lack of understanding, which the Charity Commission does not really accept as an excuse. As I say, these cases are generally of interest to charity lawyers, but briefly, Goodband versus the Charity Commission was disqualification proceedings where a trustee actually hadn't been dishonest. They had just been so single-minded that their view of where the charity should go was the only view. They didn't. They lacked objectivity to take on other people's views, and at the end of the day, the Charity Commission, there were also some unauthorised trustee benefit, not to that individual, but to somebody else. But at the end of the day, the Charity Commission did disqualify the person from being a trustee, but not from holding a senior management position, because they said this person's got lots of skills, but they were too single-minded and lacked objectivity. Groom is an interesting one about volunteers, where the court found that because the volunteer was entitled to remuneration in certain situations, it was arguable that a contract had arisen and that person was a worker. So it's an important reminder to ensure that volunteers only get to recover expenses in accordance with an expenses policy rather than some other sort of remuneration. Withers Trust was very unfortunate in that it was quite technical, but it involved a husband who murdered his wife, who was terminally ill, and then killed himself. And it was all about trying to preserve the charitable gifts in the will, because obviously, if you kill somebody, you can't benefit from the consequences of that. Zedra Financial Services was the charity that was established to pay off the national debt. There was a case to hear whether it should be applied CPRE for general charitable purposes, or whether it should be put towards reducing the charitable debt, which is obviously not paying it off, because this was worth 600 million and the national debt was 2.2 billion or something like that, zillion, whatever the number is, big. So they concluded that it should be applied to reduce the national debt rather than any other purpose. And Sherland was probably now less relevant. It was about changing charitable objectives, and an individual beneficiary objected to a change. The Charities Act now sets out a statutory process for considering whether or not a charitable company can change its purposes. So Charities Act 2022, the only bit that's not yet in place is the ex gratia payments. This was delayed because there was concern that it might entitle museums, etc., to return goods or items to their source countries. And they obviously didn't want that to happen, so it's likely to come back in an amended form. The Economic Crime and Corporate Transparency Act is, I think, probably the biggest thing on the agenda. This is a new act applying to charitable companies, focusing on preventing economic crime. There will be a process during the summer 25, spring 26, whereby directors will have to be identified, as will people with significant control. They'll have to be externally verified. So this is going to be quite an administrative burden for most charities. The Act also gives Companies House enhanced investigative and enforcement powers, allows them to cross-check data against different databases, and also introduces a new offence of failing to prevent fraud. So when one of your employees commits fraud for the benefit of the organisation rather than sort of bribery act type things. So this is actually something that we're looking at quite carefully. We've had a number of charitable company clients who are saying, well, maybe we should become a CIO. I don't think being a CIO will protect you from this level of scrutiny for that long, because I suspect they will start introducing similar verification processes. The consequences are quite severe. There can be unlimited fines and prison terms. It also applies to charitable members, or some of it will apply to the members of the charity, akin to the shareholders. We regularly find that charities forget who their members are. So that's one thing that people will really need to organise before that becomes enacted. Heather touched on the Cooperative and Community Benefit Societies Act. A number of our clients are community benefit societies and rather dreading to have to be re-registered by the Commission. Earlier conversations were about code of good governance, as Robin mentioned earlier. There is also the Employment Rights Act. I haven't covered that, but that's obviously going to be a big issue for a number of charities going forward. Thank you, Fiona.
Brilliant. Thank you so much, Andrew. I'm just looking at the clock and I realise that we've come to the end of our time now, so we're actually going to close the session. Thank you so much for everyone for giving up their time and expertise, and a special thank you to Andrew, our external expert on all things to do with charity law. I have been keeping track of the Q&A function during the session, and we've really tried to answer those questions in a live environment. So I'm sorry if we haven't been able to respond to a question that you've raised, but we will endeavour to respond to those directly. And if you've got any further questions at the end, you'll see our contact details, so please do reach out. I mentioned at the beginning, the session has been recorded and will be shared with you in the next few days, and there is a survey to complete at the end of the session. We really value your feedback, and if you'd like any follow-up, then please don't hesitate to get in touch. As Robin mentioned, our future seminars, webinars this year will very much focus on the new exposure draft once that's been published, so that we can help guide you through more of the detailed changes and the practical steps that you need to take. So please do look out for those invitations when they come through. So that just leaves me to say thank you again for joining us, and I do hope you enjoy the rest of your day. Thank you and goodbye.